Okay, so the numbers have probably stopped increasing now, so I think I will begin. Welcome everyone to today's panel session. We've got an excellent panel for you to finish this, what's been an excellent conference. I hope you've had the opportunity to see some of the other sessions in this conference. This panel session is to some degree a culmination of all the other panel sessions that have preceded in this conference. As we've seen, there's all manner of financial and business organisations and the various units within these organisations that have been grappling with this challenge of incorporating climate risk into their decision-making and reporting processes, and whether this is to comply with new legal or regulatory requirements or to actually manage such risks within their own organisations. Given the complexity of this problem of assessing the likely economic impacts of climate change, it's not surprising that many of the panelists at the conference have alluded to the difficulties of such undertakings. So today's session will hopefully offer some sort of relief for our community by providing an overview of some of the tools that are available for businesses and financial institutions to help them track and manage climate risk. For me, it's a pretty exciting panel. I'm a scientist at Oxford. My background is in environmental resource management and more recently climate change, socioeconomic impacts of climate change and mitigation pathways. But I've been in this game for a number of years, and I was at a conference recently when some colleagues presented on AI and robotics advances, and they were so optimistic about the world, that the world was just so full of possibilities. And I said to them after their presentation, you live in a very different world from me. In my world, we are constantly bombarded with bad news. Things are always seemingly getting worse in terms of environmental management. How is it that we can combine these two worlds, these two somewhat disparate worlds? How can we bring them together? And I think this is the answer here to some degree. You're going to be seeing some of the tools that are available that are pulling in data sources that were never available before. You've got information from satellites, from global circulation models, from big data sources that were never available before, and the computing power to be able to translate those into meaningful indicators for business to understand their impact on the environment and how they can navigate through these difficult waters. At the moment, we're currently organising at Oxford an international workshop with scientists looking at this problem of evaluating the many and varied impacts of climate change on our economies. So I'm very keen to see what tools are available in the business and financial world and how they have managed to translate some of the science that's coming out on likely impacts of climate change. I know from the perspective of the scientists, this is not an easy problem to solve. There's a lot of uncertainties and there's a lot of difficult information that is coming through that is hard to understand, and complexity to this problem that we don't normally have to be confronted with as far as I understand from the business perspective. As a scientist, I'm going to be looking at what the panelists are providing from the point of view of a scientist, but I don't have the experience to look at it from the point of view of the business world and the financial world, and that's what I'm going to rely on you for. So please, when you're inspired with questions, the way to throw those questions at me, I'm going to have to be able to pull those questions together and ask some of our panelists in a Q&A session at the end of this. But if you could click on the Q&A button that you should see on the bottom of your screen and put your question into that, that'll come through to me. What you might notice is you're the only question on that panel. That's not because you're the only question, it's just the way the settings work. But be assured that I'm getting all those questions through. I'm going to have each of the panelists that we have here today, I'll introduce them and then I'll have each of them speak one by one. I'll allow a clarifying question or two after each of them speak for 15 to 20 minutes, but then I'll wait till the end of all three of them, all three of their presentations before I allow the questions to be asked of the panel as a whole, just so that everyone has the opportunity to answer every question if they so choose, and I'm not going to demand that of our panelists. Okay, without further ado, I think that's all of the housekeeping. Let me introduce the first of our speakers. We have Rick Lord, who's a manager at ESG Innovation and Analytics for Trucost, which is part of S&P Global. Rick is going to be providing us with an overview of climate risk and the various climate risks and how they translated from the requirements, international requirements that you're seeing coming out of TCFD and so forth, and looking at how they can bring that financial reporting in line with those requirements. Okay, without further ado, over to you, Rick, for our first presentation. Rick, you're on mute still.
Yeah, great. Thanks, Matt. Apologies for that. Just need to get off mute. Thanks very much for the introduction. So, as Matt mentioned, my name is Rick Lord. I'm a manager in the ESG Innovation and Analytics team at Trucost, which is part of S&P Global. My day-to-day work at Trucost is kind of partly around delivering climate change research and analytics for clients, but also around developing up plans and innovation processes around new tools, data sets and models that we can use to help clients to better understand their climate risk and then to take the right kind of decisions they need to avoid risks and try to capture some of the opportunities that might arise from climate change as well. Just briefly to start, just a quick note on S&P Global and who we are. So we're a multinational company made up of 4 main business units, some of which you might be aware of, some perhaps not. S&P Global Platts is a specialist energy data provider, so a lot of connections and networks within the energy sectors and the electricity sector. S&P Dow Jones Indices is a provider of index services, so managing the S&P 500, for example, but a whole range of climate-related and ESG-related indices as well. S&P Global Ratings is one of the major ratings agencies, so very deep connections with companies around their financial performance, but also their exposure to different types of risks, many of them related to environmental and social issues. And then S&P Global Market Intelligence, which Trucost is a part of, is a provider of financial data, but increasingly also environmental and social and governance related data. And I think the acquisition of Trucost by S&P Global was really part of that push to try and build up those capabilities over time. And I think just to note as well, I think there's been a really significant top-down commitment to climate and ESG from the CEO down at S&P Global, and that's kind of integrated these ideas into all the different business units. So both in terms of improving our own performance on climate-related issues, but also making sure that we can deliver the kind of tools and data sets that our clients need to do better on climate change. Maybe just to start, and I'm sure many of the participants are very much aware of this, but there's very much been a real acceleration in interest in thinking more quantitatively and on a more of a scenario perspective around what climate risk looks like and what the implications are for companies and investors. And that's really been stimulated by the uptake around the Task Force on Climate-Related Financial Disclosures, which has kind of given a framework for sort of business managers and investors to start thinking about these questions in a structured way. And I think this quote here from Mark Carney, the governor of the Bank of England, is kind of a useful example of what's kind of driving some of that. And I think it's that we are seeing in recent years very unusual climate-related events, whether they be wildfires, hurricanes, or floods, which are very much kind of tail risks as we see them today. But that's really connecting with what the models and the science tells us about what might result from climate change in the future. So it's really that the tail risks of today could be a real kind of indicator of what we might see as the norm in the future if we don't act to the sufficient degree to try to manage climate change. When we think about climate risk, we think about it at Trucost, we kind of think about this as being really a complex interplay between physical, transition, and reputational risks. And really, it's ultimately driven by many kind of external factors to many investors and companies, in the sense that nobody really knows how well we're going to perform when managing climate change in the future. So will we take very significant action to reduce emissions over time? and that will result in very significant reputational risks, but maybe avoid some of the worst physical risks associated with climate change? Or will we do the opposite essentially and not do very much to reduce emissions, avoid some of those transition risks around regulation and technology change, but then really have to bear some of the worst consequences of climate change through those physical risks? And so it can be quite complex for investors and companies to navigate what the implications are of those different possible pathways or scenarios in the future, and then to really think about how does that affect my business model today or my investing strategy in the longer run. When we think about TCFD, when we're working with investors or companies, we like to think about it as kind of like a journey that they might go through. So really the first step in that is to start thinking about setting a baseline. So really understanding what is my contribution to climate change in terms of the emissions of the companies that I'm invested in or that I'm lending money to, or whatever the case may be. Thinking about attribution analysis. So what is driving those emissions? Is it the sectors that I'm invested in, or perhaps just more the individual stocks that I've chosen to invest in? And then really thinking about that at the portfolio level, but also digging down to individual companies and individual assets that those companies might be invested in or operating, to really understand what the root cause is of the contribution to climate change. We can then add on top of that more sector specific metrics. So taking things like exposure to fossil fuel extraction or production of energy through unsustainable means. And then also potentially as well thinking about for resource industries, to what degree you're exposed to miners that are producing more climate aligned commodities. So things maybe like copper or lithium, which are going to be needed to deliver on the solutions to climate change that we're all hoping for, versus are you very much exposed to coal extraction where that's not going to be so future aligned. The next step we could add on is scenario analysis, which was really kind of the focus and driving force behind the TCFD, to start thinking about future scenarios in a quantitative and structured way. And so we have a few tools there to try to think about that, targeting each of those three themes that I mentioned before, so transition, physical, and reputational risk. The first one is around transition risk and regulation, which is looking at carbon earnings at risk. So it's really thinking about what could be the financial implications to companies and investments based on changes in regulation over time. The second is around 2-degree alignment. So to what degree are the commitments that companies or investors have made to reduce their emissions, are they doing enough really to try to get to that 2-degree goal that we're all hoping for in the long run? And then finally, thinking about physical risk, which is kind of in the worst case scenario where we aren't able to manage climate change to a sufficient degree, what are the impacts for companies that might hold very valuable assets in locations that are going to be at risk in the future? And I'll talk a little more about each of these in the subsequent slides. And then finally, we want to bring this together into a reporting format that kind of meets the needs of our investor or corporate clients. So not so much a kind of box ticking exercise, but really trying to figure out what kind of information do they need to change their decision making, and really to make sure that what they're doing is delivering on the goal to be more climate aligned in the future. So the first data set I wanted to talk about is actually our most recent data set, and it's just looking at the question of climate change physical risk. And what we're looking to do here is to try to understand for individual equities or fixed income instruments that an investor might be invested in, what assets or operating locations around the world are tied back to that company, and what kind of physical risk might be important in those locations where those companies are operating. And so to do that, we start with a very detailed database of individual corporate assets all around the world that are mapped back to their corporate owners. So really breaking down every company into the individual site locations where they might operate around the world, and then overlaying that on these maps of climate change risk. So the one you can see here is looking at heat wave risk specifically in 2050. We can also think about that across multiple different scenarios. Obviously, given the uncertainty around how things will play out in the future, we want to look across the spectrum. And so we build up scenarios based on the IPCC's representative concentration pathways, or RCP scenarios. And these are kind of a very structured and kind of well-accepted way to think about the future outcomes of climate change. And then we can look forward across different timeframes. So we can think about what is the exposure to different types of risks today, but then in the medium term in 2030, what does that look like? And then forward to 2050 as well. So trying to target different time horizons that investors might be interested in. We also think about 7 different types of physical risk, and these would be some of the common risk factors you would think about in terms of climate change. So that includes heat waves and cold waves, so periods of extreme heat and cold, exposure to water stress, hurricanes and typhoons, depending on the part of the world you're operating in, wildfires, flooding from rivers, and sea level rise, and then trying to get a more holistic picture of the multi-dimensional risk that a company and its assets might be exposed to. And then this data can be delivered as kind of data feeds for our investor clients to use in terms of running their own analysis on their side. But also we provide kind of portfolio analysis services where we'll write reports and produce some kind of useful conclusions for clients to kind of understand what the risk exposure looks like. And then similarly, in some cases, there'll be more bespoke analysis where maybe an investor might be focused on investing in real assets, which are not publicly held. And if they know the locations of those assets, then we can run this analysis and really get an understanding of the risk exposure in the future. Just to give a quick example here, what you can see on the map here are the dot locations, the locations of physical assets owned by a European energy company. So obviously based in Europe with lots of assets there, but many assets spread across the rest of the world as well. And we can overlay those assets with maps of climate change physical risk. So in this case, we're looking at the number of heat wave days that we would expect in 2050 in a high climate change scenario. And what we can see here is that they do have some assets in equatorial regions in kind of Central America, which could be at quite high risk of heat wave in the future, but also some other assets that are in lower latitudes or also high altitude as well, where heat waves are perhaps less of a concern. And so this can be particularly important for energy companies where there's lots of outdoor workers, and the impact of extreme heat can be quite significant on productivity and being able to maintain key infrastructure. We can do the same thing here as well for something like hurricane risk. And so you can see in this case, the company has quite a few assets on the east coast of the US, which is very hurricane prone, but also some assets here you can see in Brazil where it's very much outside the normal range for hurricanes. And so at least in the near term, it's unlikely to be a significant risk factor for that company. Before we move on from physical risk, I just wanted to note a few kind of interesting findings from a paper that we published towards the end of last year. And so in this table, what you can see here is an analysis where we took some of the key headline indices for different regional markets, so essentially representing the equities in those stock exchanges, and looked at the degree to which the companies listed there own assets that are at high risk to at least one climate-related risk factor. And interesting, what we find is that in places like Australia for the ASX 200 or the US for the S&P 500, it's actually a very high percentage of those companies have quite high risk assets, about 60% for the S&P 500 and 45% for the ASX 200. And that really kind of helps to signify this kind of scale of the problem and the need to be able to better manage the physical risks of climate change in the future. And then just one second point here is another way to think about this data is to look at what kinds of physical risks are likely to be more or less important in different parts of the world. And so what you can see here is the contribution of each physical risk indicator to the overall exposure for those different markets. And so one interesting point here is if you look at the TOPIX 150, which is for Japan, you can see the aqua color to the right-hand side is quite a significant contributor. So that's looking at typhoon contributions to the risks to the portfolio. So lots of typhoons often occur in Japan, but also in East Asia, where there'll be a lot of assets for Japanese companies. And then similarly for the ASX 200 in Australia and the S&P 500 in the US, the light blue bar to the left-hand side is quite significant, which is really reflecting the risk of wildfire in those places. And so obviously over the Christmas period, we saw quite significant or historically significant fire wildfires in Australia and then in the US as well in California in the previous year. So that's physical risk. The next data set I wanted to share with you was around regulatory risk, which is really focusing on what will be the consequences of government efforts to try to reduce emissions over time. So it's really the consequences of changes to the economy rather than changes to the climate. And what this is looking at is trying to get an understanding of the financial cost that companies may need to bear if they were, as governments act to reduce their emissions over time. So carbon pricing, which means things like carbon taxes, emissions trading schemes, and other types of pricing schemes, they're really becoming much more popular mechanisms and generally seen as the most cost-effective way to reduce emissions. And so governments are adopting these policies and gradually starting to increase the prices over time. And so if you have an understanding of where in the world a company operates and how emissions intensive their activities are in those countries, we can put those two pieces of information together to understand what would be the carbon pricing risk for that company in the future. And so for a universe of about 15,000 companies, we run that analysis to look at what the cost of carbon pricing regulation would be across 3 different scenarios, so a high, moderate, and a low. And then trying to put that into more tangible terms for investors and think about what's the dollar value impact, so the increase in operating expenditures, but also what's the change in profitability or earnings for the portfolio. So changes in earnings before interest and tax, and also changes to operating margin. And so that can be a useful way to kind of hotspot in a portfolio which are the key companies that are really under threat, essentially, based on increasing carbon pricing over time. And then maybe just one extra thing to note here is that in 2019, we were fortunate enough to receive an award from the Environmental Finance Sustainable Investing Awards for this particular data set. And it was very much in recognition that this was kind of a leading edge data set that hadn't really been available before and has since become quite widely adopted in the market. Just to share as well, one other interesting finding from a paper in 2018 that we put together, which is looking at the question of, do we get any extra information from thinking about carbon pricing risk versus just looking at the carbon intensity of companies? And so what you can see in the charts at the bottom here, the bars represent the carbon, the profit at risk for each company in a particular sector. So on the left-hand side, chemicals, the right-hand side, electric utilities. And you can see there's a lot of variation there because the different activities they might be engaged in. And then the dots represent that's the bars, sorry. And then the dots represent the GHG intensity for those companies. And what we can see is that there's not necessarily a good correlation between the bars and the dots, which suggests that there may be some high carbon intensity companies that are actually more resilient to kind of maintaining their profits under a carbon regulation system, whereas other companies may be much more at risk of going essentially becoming negative profits over time. And there's a few reasons why that could occur. So it could be, for example, that some companies have high emissions activities in quite tightly regulated jurisdictions already, and so they're already adapted to that high regulation environment. But also some companies are obviously going to be more profitable than others, and so they can potentially absorb the cost of regulation, whereas other companies on tighter margins might not be able to do that. So I think the conclusion here was really that carbon pricing risk can be quite a useful measure to try to identify those companies that might be vulnerable to changes in regulation over time. And then finally, the third data set I wanted to show was what we call our 2-degree alignment or Paris alignment data set. And this is really kind of touching on the idea of reputational risks around climate change. And what this is looking to do is to provide a framework to try to understand whether or not the carbon reduction targets that companies have committed to, are those commitments enough to get us to the 2-degree goal that we're all working towards? And so doing that in an objective way, it really is helpful to try and understand which companies are maybe lagging behind and what may well be the target of campaigns or other types of damaging reputational issues in the future. So to do this, we look at a universe of about 1,300 companies, and we look back over the history of the last 6 years to see to what degree their emissions are coming down over time. And then we look at their commitments in the future to put them on a pathway to say, what do we expect their emissions to be in the next 5-10 years time? And then we can compare that with the emissions budget that's available to that company using methodologies based on the Science-Based Targeting Initiative. So rather than using it for target setting, essentially using it to say how much emissions can a company produce. And then by comparing the two, we can say, well, is that company over its allowed budget and by how much? And then is it on a 2-degree path or is it more likely on a 3 or a 4-degree path? And obviously for many companies, unfortunately at the moment, that's often the case. And so that works at the company level, but can also be rolled up to the entire portfolio. So you can say whether or not say a climate aligned portfolio is actually truly aligned with the 2-degree goal, or maybe it's kind of lagging behind and needs more action to improve on that. And I think I'm near the end of time. So just one last slide to discuss kind of a client example of where we put some of these tools together for a client. And in this case, it's for the Japanese Government Pension Investment Fund, which is one of the largest asset managers in the world. And they were very keen to try to be a leader in terms of applying the TCFD principles to understanding their investment management. And so we were able to apply many of the tools that I mentioned before, so carbon footprinting, fossil fuel exposures, 2-degree alignment, carbon earnings at risk, and so on, to try to understand the degree to which where there were weaknesses in the portfolio and where there were potentially strengths. And this was quite a particularly interesting analysis because as a pension fund was kind of broadly invested across the Japanese economy, you can use this data to kind of draw some conclusions around major Japanese companies. And what we found was that for the majority, they were actually on a 3 or 4-degree path rather than a 2-degree path. and there were some significant risks around carbon pricing that could be important for those companies. And there's a link at the bottom of the slide here in case you're interested to see more. So I think I'll stop there, and looking forward to answering any questions that anyone might have in the Q&A session.
Excellent presentation, Rick. Thank you. That was a very comprehensive overview, and that's a great way to start this panel session, because it gives everyone the background of all the different types of risks and also some of the tools that are available. I have a couple of questions here. They're not exactly clarifying questions, so I might wait until the end so that everyone actually has a chance to answer those, or I'll throw one at you. So there's many institutions out there that are competing in developing these climate tools. How often would you say we need, the business community, financial community needs to reevaluate those tools, the tools that they choose to use, given that you've got other companies out there that are producing their own versions that may not match yours, that use new data sets?
Yeah, I think it's quite a challenging time, and it's a very dynamic space. So a lot of investors and companies are very much looking to move forward on these types of questions and trying to understand their climate risk better. And there probably is a group of investors that are really on the leading edge there, and they're looking to try new data sets and new methodologies. And there will be different groups trying to crack the same problem, and they may come up with different answers, of course. But I think kind of as we move along, and as was the case with things like carbon footprinting and other methodologies, we'll settle down towards around kind of a mutually agreed framework, which kind of, I think, becomes the new standard essentially, whether it's a de facto standard or a regulated standard. And that ultimately will be adopted by the much broader community. So I think kind of the interplay between leading edge investors and some of the service providers helps us to figure out what is the right way to do and to analyze some of these questions. And then I think we'll settle back to something that is kind of, will be consistent across all the providers in the future, I would say.
Okay, great. Interesting idea. Okay, I think for time purposes, I'll move on there, Rick, but I'll ask you to stay on for the panel discussion afterwards, where I'll bring up those other questions that have come in. But thank you for an excellent presentation.
Thank you.
Our second speaker is Ruben Mahindi Wambi, who is the African Regional Coordinator for UNEP Finance Initiative. For those that are not sure of what that is or who that is, the UN Principles for Responsible Banking have been adopted in 170 banks around the world with 47 trillion of assets. UNEP FI has helped to promote and support sustainable financing by working with banks, insurers and investors and helping them to integrate ESG factors. Ruben leads the adoption and implementation of the UN Principles for Responsible Banking and Principles for Sustainable Insurance by banks and insurers in Africa. So there was a few questions there about climate risk in Africa, and hopefully Ruben will be able to provide some information there. His talk will cover some of the tools that are available to financial institutions to manage climate risks, including tools for scenario-based impact analysis for banks, the assessment of climate-related risk for opportunities for banks, and offerings from UNEP FI for assessing exposure to climate risk. Over to you, Ruben.
Thank you very much, Matt, and great to have you all. I am going to share my screen now. So as Matt mentioned, I lead the work of UNEP FI within Sub-Saharan Africa, where we have a membership of 22 plus banks and for the principles of responsible banking, and more than 30 insurance companies for the principles of sustainable insurance. As you can well imagine, the topic of climate risk has become a key priority within the banking sector, and especially twofold for Africa. One, for a long time, the issue of climate risk was very Eurocentric in terms of the discussion. And, this is something that, banks are starting to adapt within Africa. But also secondly, we have, so many tools and standards and frameworks which you can potentially imagine in the market. as far as Task Force for Climate-Related Financial Disclosures, TCFD, we have the GRI, we have the Sustainability Accounting and Standards Board. We have, we had the Carbon Disclosure Project, and many more frameworks. Some intersecting, some with their very specific value proposition. And so the question becomes, what options do banks have? And what we do at UNEP-FI is by banks signing up to become members of the principles of responsible banking, then we give them access to how to use tools which are related to climate risk analysis. And most of these tools actually are open source and open to people and the public beyond UNEP-FI. But what helps is that their development has been by UNEP-FI member banks, and they become the first to use, but also there's the added advantage of the peer exchange. So for my presentation, I'm going to focus on two things. One is impact analysis as a key aspect of managing climate risk, because most of the time climate risk is viewed from a view of this is an exogenous shock being experienced by banks and insurance companies and investors, without really looking at how do the operations of the financial institutions actually play a role in exacerbating the climate risk crisis. But also secondly, is share with you one of the tools we have within UNEP-FI, which looks at natural capital risk. Because the discussion on climate change is not complete without looking at biodiversity loss and ecosystems and natural capital systems, and asking ourselves, is there a way that natural capital risk can actually be included as part of the broader climate change discussion? So to start with, if you think about the landscape of climate risk, there are a number of objectives, but I've narrowed them down to three. So one, as a bank or insurance company or investor or any other company, just that I mostly work with financial institutions, you can either be targeted at reducing exposure to climate risk, and as Rick was going through his presentation, you could see how the different exposures, be it to physical transition risk, actually feed on into institutions. And more often than not, you want to avoid your credit risk, you want to avoid reputation risk. Much of this has been discussed in earlier sessions about physical and transition risk. But also the second thing, you may want to reduce the climate impact of your assets under management. And here, your interest will be the composition of your portfolio, and you want to divest from heavy carbon and heavy fossil fuel sectors. And just to make sure the green versus brown share of your portfolio is per your targets, and have a low brown share of your portfolio as much as possible. And there's the whole greening of your portfolio. But thirdly, you also want be beyond just reducing risk and impact. You also want, as an institution, to provide leadership in contributing to the transition to low carbon economy. And much of this is like through investment in low carbon technologies, to replace heavy carbon, and technologies like carbon sequestration, and just to reduce carbon footprint. And regardless of which objective you want to pursue, you can do it at three levels. You can either do it at the company level or business unit level. So if you're a bank, you may choose to look at credit department, or your risk management business unit, and focus your energies there and set your targets and your strategy at a unit level. Or you can actually do at a portfolio level. So think of yourself as an asset manager. You may just want to look at, say, your utilities portfolio, or your real estate portfolio, or your transport portfolio, or agriculture portfolio. And just to give context, like a country like Kenya, when you look at their submissions for the nationally determined contributions, the key sectors are agriculture, transport, land use and land use change. And when you look at these sectors, you'd also want, as an asset manager, to ask yourself, if I have portfolios, within the country and investment within the country, how can I manage climate risk or target climate risk management at a portfolio level? And then something worth mentioning is how to, how approach and think around climate risk management. Rick mentioned many of these in his presentation, but just a couple of things in terms of, it's more like aligned in terms of how do you think in a process way. So there's vulnerability, vulnerability being your, whether there's a hurricane happening, if it's physical risk, whether they are, you're vulnerable to floods, you're vulnerable to heat waves, tornadoes, cyclones, and all these physical risks. Or from a transition point of view, you could be vulnerable to new regulation coming, or you could be vulnerable to new technology that maybe replaces coal if you're highly invested in the coal industry and stuff like that. But also depending on your financial holding, and how your investments are composed, then there's the element of exposure, because you may have say a portfolio with very high vulnerability but very low exposure in a particular asset class, or maybe low vulnerability but very high exposure, depending on how you balance your asset. Then the question becomes, how does that risk, physical or transition risk, feed into your risk as a business? And then you have to think about the impact drivers. What's driving that risk? Does it mean, is it physical destruction that is going to happen? Does this mean, your revenue is at risk? Does it mean you have to spend so much in terms of managing cost of emissions? And then that leads you to your risk pathways. And, there are different ways and a lot of science that has gone into climate risk pathways, which I don't want to go into. Then there's a whole case about scenario. We all know, with the Paris Agreement, we are looking at 2 and, limiting it to, under 2 and aiming for 1.5. Then once you've been able to tell what's your risk and your drivers and your pathways, you have to think about what's the impact. And as I mentioned, the impact could be at corporate level, unit level, or your portfolio. Then at that level, if you want to think about management, then you have to think about measures and targets, because you have to determine within your risk management framework, what measures and metrics are you most interested in, and what are your targets as a company, and then that leads into your tools deployment. So this is just an overview, in case someone is listening and you're new to climate risk management. But what I want to focus on is 2 tools, and the contribution of this is one. I want to show you one of the tools we've developed within Unipify. Maybe I'll not have time to do a demo of how we look at impact analysis, but also to how we are going about natural capital risk within financial institutions. So one tool we have is called the impact analysis tool, which has been developed by the Unipify member banks within globally. And also, within that particular working group that has developed them, we have key banks from Africa, which are part of the Principles of Responsible Banking core group. And the tool is twofold. So we have a corporate impact analysis tool and a portfolio impact analysis tool. So what does the tool do? The tool is aimed at one thing and saying, okay, can we have a methodology? And this tool is actually, and you can try it if you just Google Unipify impact analysis tool, you'll find it online. It's open source and currently on Excel, but we intend to make it give it more functionality, and you can actually use it online. It's how can you identify and assess the significant impact areas in your bank portfolio. Because as we currently know, every portfolio per se does not necessarily link to one impact area as far as the climate change or the environment is concerned. So there are implications for different sectors. There are implications, say, for the energy sector, for food, for, say, nature, but also other sectors. Like you could have your portfolio which has some impact, say in terms of gender, because you could have loans which are targeted, say for example, I know some countries, they have loans targeted for women groups. And the question becomes, how do you actually link what you're doing within your portfolio and whether it's actually managing that risk and meeting particular impact areas. And the way the tool works in terms of just explaining the mechanisms is the tool is based on, an impact radar that we've developed within UNEP-FI. And if I could explain from the circle, so within the circle, we've identified, different impact radars and tried to group them. And within I think this should be gray. I want to trust my knowledge of colors. We have, aspects that have to do with the environment. So we have waste, we have climate, we have issues to do with, resource efficiency, biodiversity, we have soils, we have air, and we have water. So what the tool does is, depending on the country, we've been able to feed like country targets into the tool, and you can be able to say, so if my portfolio is investments within South Africa, for example, these are what the country targets are looking like in each of these impact radars. Then the tool asks you to submit numbers from your portfolio, which are aligned to that particular sector. And it's like any tool you'd imagine, you feed it numbers, with the point being, at the very end, you want to have a sense of like, if you take your portfolio and analyze it, not just in terms of like, risk return metrics or relationship, but how does how does the impact of your portfolio link to each of the impact areas identified within the UNEP-FI impact radar? So as a sense, we have the identification bit and we have the assessment bit. And the end goal of this is, if a bank is able to know how the impact analysis of their portfolio or at their corporate level for each of these sectors, then they can be able to drive or set goals within the next iteration and say, we want to have a greater impact within energy, or we want to have a greater impact within the mining sector, or a greater impact within housing, and all these different sectors. And as you can tell, all the impact radar sectors, in a way or the other, they tie up to the sustainable development goals. And that is how the impact analysis tools work. And the way we've developed it, there's the technical specification within the tool interface, which explains, the whole process and how the radar works, and which are the inputs and outputs to expect. So that's on the impact analysis part of this tool. Then we have another tool which we just launched in April, and this is called ENCO tool, where ENCO stands for Exploring Natural Capital Opportunities, Risks and Exposure. And the key aim of this tool, as I had earlier mentioned, is just to visualize how the economy depends on nature and how environmental change creates risks for business. And here there are three key questions you're asking, like, how does business depend on nature? How does environmental change affect these dependencies within nature and within ecosystems? And what can be measured to gain insights on natural capital risk, based on your analysis of where your business stands? And that is just a snapshot of the ENCO homepage. So if you actually just Google ENCO tool, you will find the homepage that looks like this, and you can be able to experiment. I'm just gonna show you an example. So before I do that, let me just show you the workings. So within the ENCO tool, we have been able to feed it with the different sectors. And just to give you an overview, when we talk about natural capital assets or natural capital or ecosystem, there are different assets. One of them is land. We have oceans, we have water, we have habitat, where all the different species live. We have the species themselves, and we've been able to categorize. We have soil and sediments. We've been able to categorize them into 8 or so natural capital assets to think about them that way. Then for each sector, we say, what are the production processes, or what are the mechanisms that happen in each sector? So for example, within agriculture, or say hydropower production, and then we ask, what is the impact that comes from that particular sector to you as a business, depending on how you think about it. So if you're loaning to farmers and there's all this happening, there's erosion happening, and there's change in temperature, which is more erratic, and rainfall, what is the impact for you as a business? And with that impact, what does that mean for natural capital? So we know if it's climate change and temperature changes, we know that has an implications for rainfall, for soil, for habitats and all that. Then we ask, from that natural capital, how does it affect the codependencies within the system? And whether that natural capital, is consumptive in terms of like as you use this, you remove it from the natural environment, or non-consumptive. Then you look at the entire loop. Then how does that affect the sector? And all this we have documented. And here is an example. I'm not sure how clear you can see it, but this is an analysis if you want to look at hydropower production. So in the tool, you would go to utilities sectors, then you have to choose your sub-industry, then the production process will be hydropower production. And then we can tell within hydropower production, the impact drivers for that particular process is the use of water and terrestrial ecosystem use. And all these icons you see next to the impact drivers, these are the icons of the different natural capitals that exist within the ecosystem, and you're able to see what is the impact on each of them. And this tool, with its development, we've seen its application by our member banks. And more recently, actually, this week, the central bank, the Dutch central bank, actually used the ENCO tool to produce a report where they have actually said, biodiversity loss is a key, is material for financial risk. So it has applications for financial institutions and also for regulators. And the last thing to mention on this tool for natural capital is that we are now developing phase 2, and phase 2 is to say it's not enough for banks or financial institutions, and also including insurance companies, more importantly, to know what is the effect of their business operations on natural capital, or to know how natural capital affects their business. We want to ask, how can we help financial institutions to actually align their financial portfolio with biodiversity targets? So we have the global biodiversity framework, and we ask, with this tool, businesses should be able to answer at least 2 questions. How are investments harming or building resilience of biodiversity in the region where we operate? So whether your country is in the tropics or is in a different environment, and is our portfolio actually in alignment with global or regional biodiversity goals? So that's it for the impact analysis tool, and for the ENCO natural capital tool. The last thing to mention is that one of the motivations for doing this is because many financial institutions in Africa, as you may imagine, as an investor or as an asset manager or as a bank or as an insurer, it's not your day-to-day core business to do modeling of this. Probably the much you go, last time I worked in a bank, most of what we did was, running our scenarios, creating our scenarios and very specific, climate scenarios, and feeding that into stress test models. So given that that is not the core business, but it's important for banks, we want to offer tools which are co-developed by member banks within UNEP-FI, and making them open access, because we believe the more many people or many actors within the financial system can adopt proper climate risk management, then it's a win-win for the industry. So thank you very much. Matt, up to you.
Wonderful. Thank you, Ruben. That was an excellent presentation, and there's some stuff there that I haven't seen before. So that was really interesting for me. I haven't seen this climate risk incorporated into natural capital accounting like that before. That's really interesting stuff. And we've actually got a question here that, knowing what Bardi is going to present next, which is not about transition risk, I think I'll ask both of you if you wouldn't mind. People are wondering about the development goals of particular countries, Africa in particular. In this case, they're wanting to grow. They're more than likely will be investing in fossil fuels, whereas in European countries, as Rick showed, the regulatory environment is much more tightly controlled in terms of those emissions. How do you incorporate the country's specific development requirements into your risk assessments? And akin to that question is, how do you incorporate the possibility of future policy changes into your risk assessments so that at some point that might change in developing countries?
Should I answer now?
Yes, please.
Okay, so I think there are two parts to that question. I think the first one is, how do you incorporate, country-specific metrics or like, environment? I think, so one way of doing it is every country has, again, their, nationally determined contributions and indices which you submit to, UNFCCC, for what are your targets, say by 2030, or by 2045 and stuff like that. But, at least countries have by 2030. And specific countries also have their climate change plans. So if you think in the UK, you have your UK Green Strategy. In Kenya, we have, the Climate Change Action Plan. So the thing is, because you want to turn those goals into metrics, one key thing to do is either you feed in the target and say, we want to support the target as envisioned by our country or the ministry. Or instead of using targets, you can actually use your baseline numbers within the tool. And the baseline is saying, okay, we have the idea of maybe reducing emissions or greenhouse gas emissions by 30% by 2030. But what are the baseline numbers as at now? So you have your metric equivalents of CO2, and that feeds into your model in terms of the baseline and what you intend to achieve. But also remembering the way we've put in the impact analysis tool, it's not based on targets, right? Because it's based on if I can show here, you actually analyzing your portfolio based on your portfolio numbers feeding, then depending on the results, where now those numbers will be useful, like your indices number is in the result, which is the target setting, and how much you want to align your targets to national targets or like UN-led SDG targets. The second question is about many economies in Africa. If you look at emissions, it's quite disproportionate in terms of your advanced economies. And there's been the argument that it could be unfair, to be asking African economies to decolonize at a time when they're just picking up on industrialization. So the question here, the way I see it is, one, you either ask yourself, do you want to use market interventions? And a good market intervention is like the carbon carbon tax, right? So if you use carbon tax, then you're using a market mechanism to make sure whoever goes into that, there's a price to pay for it. Then that way you let the market be. But as we know, markets have failed us in terms of mitigation and adaptation to climate change. But I think the second thing is about regulation. And this is where, your transition to a low carbon economy comes in. In my own, and this is my opinion, it may come at a very huge cost in terms of, foregoing some intended potential levels of, industrial activity. But also think again, the more we have development of low carbon technologies, maybe even the potential we talk about in heavy carbon may not be existent in 15 years, right? Because countries like in Africa and say in Middle East, which I work with my Middle East coordinator so much, well, they feel that there's so much potential left, within say oil and gas, with new technologies for fuel and maybe for transport. We don't know that those sectors will be as lucrative in the next 15 years. also because people are becoming more carbon conscious. And so when investors divest, there may not be, the supply side of the market may be affected, even though the demand for those particular investments is still there. So yeah, it's not a very direct answer, Matt. I'm sorry, I don't have
No,
one.
that's fine. I'll actually give my personal opinion is I think what's happening with renewables and the cost decreases that are happening there will probably push the market towards more renewable energy, and that will make a big difference. But my question, Rick, is more around to what extent can you incorporate the goals of a country and also the policies within your risk assessments for individual banks and corporations?
As it is currently.
Sorry, that was to Rick Rubin. Sorry.
Okay.
Sure. So I think it's a great question, and I think a lot of what we do at Trigos is really trying to get down to kind of national and sometimes even subnational policies around climate regulation. So to give you an example, in the carbon earnings at risk analysis, what we're looking at there is trying to get a good understanding of what kind of policies already exist in place in different countries, but also in different sectors in those countries. So for example, they might be more advanced on any electricity regulation, but not on other types of sectors, and really trying to get an understanding of that. And then really looking at how fast do we think those countries might move and then advancing the regulation over time. And so that we can get that country context, so that we can understand that if a company has some exposure to, say, South Africa or different countries around the world, they might have different levels of risk exposure based on those operations in those different parts of the world. And that can be useful for an investor, really, because they may kind of see a company as being headquartered in one country and not really think about where in the world they actually have their operations and what kinds of regulations might be important going forward.
Excellent. Thank you both for your answer to that question. And Reuben, thank you again for your presentation. For time purposes, Bardia, I'll get you to start up your presentation. Bardia, I know from Oxford, he's an alumni at Oxford, but he now oversees the operational strategic initiatives at Alice Insights. It's a Toronto-based climate analytic firm. He works on focusing the information pipelines that they're getting in and seeing how they can provide leverage points for understanding climate risk. One of the reasons why I wanted Bardia to present in this conference is he's going to go down to the much more nitty-gritty level and looking at how do you translate the research that's coming out of the scientific community into direct climate risk on assets and investments. So a bit more chiseled down detail that I think people will appreciate. Over to you, Bardia.
Thanks, Matt. Good morning or afternoon or evening to everyone. My name is Bardia. I'm the COO and co-founder of Alice Insights. It's nice to virtually be back in Oxford, and thanks for Nicoa for hosting this conference. So a bit about Alice. So we are a SaaS company. And we leverage data science and machine learning to forecast the physical risks for physical climate risk for financial decision makers. We operate cloud-based softwares where we are automating the process of modeling the physical world, different Earth systems, such that we may provide decision support to asset owners and managers globally. So we're based out of Toronto, as Matt mentioned. We're a growing team, a very interdisciplinary team from various data-driven fields, such as computational systems, neuroscience, machine learning, pure mathematics, physics, etc. Our backgrounds were from all over the world. University of Toronto, a huge contingency from there, Oxford, Stanford, and LSE. And what we do is we combine the expertise of cutting edge researchers on the cutting edge from institutions like the Environmental Change Institute here at Oxford, with the oversight of a very strong advisory board that can help guide on real decisions that people in the infrastructure asset management or general asset management and policymaking space to understand how they can better leverage our models. And we do that by also combining the latest expertise from very interdisciplinary fields. So a bit about, I'll start with a very uncontroversial, hopefully an uncontroversial statement. Climate change is generating known and unknown physical risks to assets globally. So we'll start with a bit of the known. This data is from the IPCC and also Our World in Data. So we have the Great Acceleration. We know that there's been an exponential increase in CO2 emissions by various fossil fuel types. This has increased our CO2 concentrations to levels that we have not seen in human history. And we know, based on various observations, that there are global temperature anomalies, and this is as a result of increasing CO2 emissions. So that is our known. Kind of foraying a little bit more into the unknown, which is the IPCC has made fantastic progress in developing models with a pretty high degree of confidence that our globe is on a warming trend and that this will create a shift in the distribution of weather states. And this creates a lot of uncertainty for companies and businesses around the world. So the TCFD, I believe, is correct in mentioning that well, in this case, physical climate risk, but climate-related risk in general is non-diversifiable. But when we try to actually get down to the specific asset level or the sector level, it becomes a lot more difficult and becomes a lot more uncertain to actually quantify its impacts. When we initially started this business, I remember people saying, well, climate change, who's going to deny that and the impacts? It's the case is there. But when you actually try to bring the impacts down to specific industries, specific assets, it becomes very sophisticated. And so these are some of the questions that people ask. So from different sectors, from different clients that we've dealt with. So for example, in energy, if you're running a hydropower plant, which we'll show an example of, you're going to want to know, will stream flow change, for example, will that impact your generation? If you're running a mining operation, you're going to want to understand some of the tail end risks, whether there's going to be a shift in that. Should you relocate? Very real decisions that people need to make. Real estate, I think, is a no-brainer for many. Insurance business has been on the forefront of climate change for a long time now. Do they need to adjust premiums to better reflect the impacts of climate? So the current landscape for understanding physical climate risk, and I understand the presentations that we've seen are there's a lot of great tools that are emerging for physical climate risk. I want to kind of dig deeper into some of the underlying models that people are using right now and some of the underlying methods. So we have integrated assessment models, and these models have done a really fantastic job, I'd say, at bringing to light the macroeconomic impacts of climate change and its potential. They're just not designed for asset level risk, and that's okay. They serve a different function. Freddie Otto, my former professor yesterday, gave a really great talk on wild weather, and she put this figure that I kind of stole from here. But the Nordhaus model, for example, a very famous IAM, highly underestimated the impacts of climate change on the U.S. economy. So it predicted an impact of 20 billion. One hurricane created a economic cost of 67 billion. So there's that in and of itself is, I think, a testament to how much these models can underestimate the impacts. Academic and engineering reports and studies, really great. We leverage them a lot to get that expertise to understand how the climate is changing, some of its underlying trends, and how it can impact different sectors. Problem is the findings are difficult to scale beyond target asset or location, and they're static. They don't update with new information. So if you're reading a report from 5-10 years ago, it's difficult to see how it's changed with new observations or new techniques. And the in-house approach, this is being advocated by various institutions. And while I think that in-house approach is very important, in order for companies to get together, put their heads together with different experts on various sectors. A lot of these companies are massive, they're quite siloed. It requires a really interdisciplinary team, a lot of domain expertise, and it's a lot of time and resources. And the problem is, what we've seen is that, if you're working with a company to try to understand the impacts of climate on, let's say, a power plant, there's going to be an expert that's dealing with one specific type of risk to that plant. There's going to be another person siloed off dealing with another risk. So having risk outputs within a team between teams that are siloed and having them comparable is very difficult. So you can't actually do sort of a across the board assessment of your risk. So the Canadian Expert Panel on Sustainable Finance, sort of provocative quote, I would say, but I think it's still pretty accurate, is that the financial sector is just beginning to understand the impacts of this. It's a very chaotic risk. And so we are just beginning to assess, measure, and manage climate-related risk and opportunity. So going back off some of the critiques, I wouldn't really call it critiques, but just general an assessment of the available models that I discussed, whether it's IAMs or specific reports or in-house approach. There's a few things that people require, a few attributes to, if you were to develop a platform that would make, I would call a climate risk platform very actionable. So first, it needs to be asset specific. So Rick, in his presentation, I think we really went down to the asset level. I think that's really important. But the key is you need to translate those impacts into financial performance metrics that matter to those asset owners and managers. So it's, we can discuss generally the trend of climate change, but to actually say this is how it ties to your generation, this is how it ties to your costs, is really key for people to have confidence in the models to actually make a large decision off of it. It needs to be globally scalable. So by that, I'm touching again on the sort of the academic or engineering approach, is that can you take a finding? So some firms, for example, engineering consulting firms, have a wealth of knowledge on the asset itself, one asset. Can they do that same study for hundreds and hundreds of assets across the globe, which is typically the portfolio of a really large company? And it's very difficult to do that. So, and dynamic, we're dealing with, at times, really unlikely, I'll quote unquote, unlikely events with, for example, extreme weather, heat waves, hurricanes, etc. Your model should be updating based on those seemingly unlikely. Your worldview should be updated. If something happened that you didn't think could have happened before, you should update your worldview if that thing happens. So that's really key. It incorporates latest expertise. I mean, funding and time and commitment put into climate research is just exponentiating around the globe, especially in regions such as Africa. I know there's an Africa focus for this conference. We have Future Climate for Africa. We have Impala. We have a lot of different consortia that are trying to make sense of a lot of the underlying trends and systems pertinent to Africa's atmospheric system. Very large continent, of course, you need to divide it into the different regions, but that you need a platform that can incorporate that research very rapidly. And it needs to be reliable and it needs to be scenario based. So I'll be showing in some of the case studies how important it is to really communicate the uncertainty of your models. It needs to be tested, it needs to be validated, and often a lot of clients are going to be pretty skeptical of the model, which takes a lot of time to try to get them to understand what it is that you're presenting to them. That's a really important process. So as I mentioned, Alice is a software business, and we service currently through Dashboard. We also will be building out an API, and we also can service through automated reports if that's a delivery method that the client wants. So we've broken down our process, what our platform is doing, into sort of 3 sections. There's a lot more to it, but we'll simplify it for this presentation. So the first is being able to integrate lots and lots of data. If you want good models, if you want to increase, you need more observations, you need a lot of simulations incorporated, such that we can get to whatever we want to call the true value of that we're trying to better understand. And so we incorporate a lot of data from CMIP, CMIP 5, CMIP 6 as the data is rolling out. For global and regional atmospheric data, we take a lot of historical data for the area of focus. We use the intersectoral impact models, ISI-MIP, for more downscaled or more hydrological data for our models. And then we can also contextualize for specific assets based on remote sensing technology. I think as anybody who's done any sort of modeling work can attest to, this takes a lot, like trying to organize your data takes a lot of time. So this helps us cut down on a lot of the modeling that we do. such that we can run large scale statistical and machine learning experiments. So that leads to my second part. We leverage artificial intelligence, specifically machine learning techniques. There's a lot of tools. It's a very loaded word, so it really depends. We can do something as simple as a linear regression. We can do something as complex as a neural net based on the problem. But what we're trying to really get down to is understanding, based on more information, more simulations that we add to our models, how can we generate better probabilistic outputs for specific climate drivers? Once we receive those climate drivers, which we're developing a centralized database for, what we can do now is actually understand the relationship between the climate drivers and the assets of interest. So we take lots and lots of public and third-party asset data, train our models, and we can essentially pick up on some of the relationships between financial performance and the climate. We're not trying to predict everything about the asset. What we're trying to do is give better information in the context of a changing climate. How can the performance of an asset change? And we model that out from between now and 2100, or anywhere between that, based on the sector or the asset of interest. Again, just kind of breaking down the drivers here. Again, this is very simplistic, I would say, but I think it helps divide the way in which we're thinking about it. So it gets more complex as you go down from climate drivers. So you have your atmospheric variables, temperature and precipitation, which is what these CMIT models produce. Then from that, you can derive information based on heat waves, acute temperature, chronic temperature changes, so overall mean surface temperature, chronic precipitation, acute, extreme, and then it starts getting more complex. Secondary variables. So what is the relationship of those variables with the physical environment? So this is where hydrological modeling comes in. We have tertiary, so these are human influence factors. That really is not an easy thing to do, I would say. It's one thing to say there's going to be a decrease in precipitation and runoff in a certain area. It's another to understand how the human environment, the human asset, we'll call it, is interacting with that water supply source. So it requires more modeling work on that. And then we'll categorize some of the other acute events, such as tropical cyclones, acute or chronic wind, and also we're looking at permafrost. So here's some case studies. So I wanted to show you guys some of the outputs. It's not from our dashboard specifically. These are just the underlying data that we put in static plots. So we have hydropower and agriculture. So hydropower is an interesting one. So there is not much agreement actually in the literature on the global impacts of climate change on hydropower. It can range between a 10% global increase in hydropower production. So hydropower represents, I think, about 15 to 20% of the world's energy production, so pretty significant. And that sort of disagreement in the literature is all the more reason to try to get down to the asset level and understand how climate is going to impact the financial performance. So there are two really important things about hydropower. One is the productivity of the asset, so how much inflow is going in and how much generation can it produce. The second is actually safety, and which requires a lot of sophisticated modeling work because you're looking at now tail end risk and you're looking at volatility. Questions that were asked by some of our clients in the hydropower space, very simply, should I sell this asset or should I keep investing? This is really the stage that we are at for some areas. Very serious, big decisions that can have major implications for someone's portfolio. Looking at other aspects like, should I increase the resilience of this asset to variations in peak flow? So we developed a model based on a lot of different factors. So first we had to incorporate a lot of observational data. We took, this is in Northeast United States, so a lot of the wet states. So I'll explain some of what we're seeing here in a second. So we had to incorporate more than 30 global climate models. We took a lot of downscaled models from NASA and Cordex. We also had to incorporate hydrological data. We incorporated thousands of different sensor data to understand the specific impacts of climate. We also had to take a lot of the hydrological and climate models and then route them to get them down to the variable of stream flow. So what you're looking at here is for a number of the gauges. So this model we can scale to pretty much anywhere in the world. We've already scaled it to every sensor on the USGS in the United States, which is very exciting. It's going to provide a lot of valuable information to asset owners and managers. This one is interesting because we're seeing a rightward shift in stream flow. So a rightward shift in the distribution. So essentially we can expect an increased amount of inflows into the hydropower plant, but it's more complex than that because it's not just about the mean. We need to actually assess tail end risk as well, which I won't go into for this presentation, but we are doing that sort of extreme event analysis as well. And that will inform decisions such as, do we need to build higher dams, for example. Once we have that probabilistic output, what's really exciting is we can aggregate a lot of data on generation, and through a data mining approach, we can actually see the relationship between inflows and generation. Now, I know it may seem common sense. Of course, inflows would have a relationship with generation. It's not as simple to find those relationships all the time because a lot of your future generation is determined by decisions that you make, human decisions as well. So we're not trying to show, for example, a full. We're not trying to prove that all discharge, all generation comes from discharge. We're just trying to provide a little bit more predictive power. And so, yeah. And one of the exciting parts about the machine learning approach is that your model performance will improve as your sample size increases, which we do constantly. Okay, Canada, where I am currently. So Wall Street Journal last year or 2 years ago released an article entitled "A Warming Climate Brings New Crops to Frigid Zones." So we talked about climate risk, and opportunity. There was opportunity in there in the hydropower example. This one we're also going to talk a bit about opportunity. So a bit about Canada. So Canada on average is warming twice the global rate. Pretty alarming. And Northern Canada is heating up at almost 3 times the global average. And this has a major impact for the Canadian economy. If you can imagine, a lot of our economy is dependent on agriculture. And so there are this area over here, these are the prairies. And so between Alberta, Saskatchewan, and Manitoba, if in 2013 you went to a farmer and said, can you grow soybeans on this land? Answer would probably be no. Now it's in 2018, soybeans covered 425,000 acres. It's a very dramatic shift, and that shift is continuing. Some of the businesses that we spoke to are seeing a 30% increase in profitability as a result of this. So of course, we now have a lot of clients coming and asking questions such as how will the growing degree days change? How will precipitation patterns change? Will droughts become more likely? Questions that will inform a lot of big decisions. So we looked at 2 farms, very simple example here, just to see. So for this one we did, so just a bit about growing degree days. It helps us estimate the growth of plants and also insects. And it accumulates whenever the daily mean temperature is above a specified threshold temperature. So we use, so 5 degrees is for canola, for example. That's really valuable. 10 degrees is for assessing the growth of corn and soybeans. 15 degrees, you're going to start worrying about insects and pests and things like that. So for purpose of this case study, we're looking at 10 degrees. So this is for between 1980 to 2000 versus 2020 to 2040. So on the left, we have a probability distribution. We won't focus too much on the bimodality of this distribution. It's just seasonal shifts, which in and of itself is a very interesting insight here. But what I do want to bring to attention is that red is historical, blue is predicted, blue is shifting right. The temperature in that area and that for that farm is going to become warmer. And so that is a very insightful piece of information for someone to make a decision as to whether or not that land, for example, is being undervalued. And so you can buy that earlier and you can now start growing crops that maybe the people who didn't have this sort of analytics didn't know. And so it was undervalued. Similar phenomenon we're seeing for the second farm. So just some concluding thoughts on this. Models need to be useful and they need to be practical, and you need to bring it down to metrics that are pertinent to the asset. So that's something that Alice really focuses on. And we will always go out and try to learn more about the industry to try to improve our software such that it's highly actionable. Another really big thing, and this is I don't want to make too much of a distinction. We rely heavily on academia, but I think some of the divide sometimes comes from there's a little of an obsession with always trying to paint a story of things being pretty certain or your models being really good. If you communicate uncertainty, that's okay. So long as you can show that your model gives even a little bit better information. If you can backtest it, for example, show if you had this model and 20 or 30 years ago, you would have had just that much better information. That already is highly valuable. Why is that? Because the largest companies in the world, they're not making one small bet. They're making many large bets. So even an incremental improvement in how you're viewing the world in a very imperfect and a very chaotic world, that's going to go a long way for you, especially if you're looking at compound returns over a long time period. Some of our clients, for example, hold on to assets for more than 50 years. So that sort of information is very important. And that kind of naturally goes into my third point, which is you need to communicate distributions and uncertainty for decision-making and risk management. Kuhnreuther, for example, in 2013, there was a very insightful paper along with, I think, Miles as well, Miles Allen, where they looked at why it's important to be able to show the distribution and tail end risks. And it's up to decision makers to see whether that fits into their risk appetite and their risk management practices. So I will just end it on that. I'm not sure how much time we have for Q&A, but thank you.
Wonderful. Thank you, Bardia. I appreciate that. I've got sorry, I should say how excellent that presentation was, and knowing your stuff, you had a lot more to present. So thank you for being concise with the 15 minutes that you had. We are running out of time, so I'm going to have to ask some questions to the group as a whole, but I'll ask you to answer first, Bardia. Because a lot of people are asking, a lot of viewers are from Africa, and they're wanting to know to what extent your information can be applied, your analytics can be applied to the African context.
Yeah, so I was trying to think of analogies to try to describe this. I think Google Maps, when it was first released, right, what you had was essentially various layers of information for satellite imagery. And in certain areas, it was very high resolution, and in certain areas it was a bit more low resolution. That didn't mean that in general, just because it was a bit more low resolution, it was completely useless. As I mentioned in my presentation, there's a lot of different ways you can still make a lot of this information useful. Now, with that being said, one thing that we focused on is make sure that our platform was very scalable. It's always global. So just on the basis of the global climate models from the CMIP, we can provide some insights. Now, I understand that there are, I believe, I hope I'm not mistaken here, there are no Africa-focused climate models from CMIP, although there's a lot of initiatives that are currently being developed. There's a lot of statistically downscaling methods. Again, that's still not from Africa-focused models. So again, the way in which they capture internal variability of the climate in different areas is going to be hard. But still, just because it's a bit more low resolution right now does not mean it's not going to provide useful information. I will also add that by using a machine learning approach, you can essentially layer in a lot of information as it comes. So that's why I mentioned different examples. Just some areas, that's why I have it in front of me. But we have the Future Climate for Africa. We have Project Impala, which is a Pan-African high-resolution model that I believe is released 4 kilometer resolution. So really great. You have AMA 2050. Looks at monsoon, and you have different organizations that are looking to reduce uncertainty in that region. So we're going to really assess. We're always keeping an eye on the latest models. Matt, you also know this. I talk to you a lot about what models we can use all the time. And so what I would say is, we can and we are developing models for that region. We will also continue to improve it as time goes by. Yeah.
Fantastic. Thanks, mate. Now we're running out of time, and that is my fault. I should have been more strict on the timing. We've got a lot of questions there. It's been fantastic how many people have asked questions. Now, I'm not going to be able to get to them all, but these questions are going to be sent to our panelists, and those panelists can reply to you directly. So please throw some more questions in if you want. Just one generalized question to everyone, if I could, and Rick, I'll start with you. We've seen over this conference, a lot of the conversation has been around ESGs and incorporating an understanding of various risks, not just climate risk, into ESGs. Have you got any advice for those accountants, people that are running business units, portfolios, how they can incorporate climate risk into the generalized frameworks of ESG?
Yeah, I think that's a great question. And I think kind of ESG as a concept has really had a boost in the last few years in terms of interest from investors, but also from companies. And I think the interesting about ESG, I guess, is that as we're kind of getting more of a handle on climate and by having you to think about that in terms of risk, when we broaden the view to ESG in general, we're entering into a whole range of different topic areas, from other environmental impacts like biodiversity or air pollution and so on, through to social and governance issues that maybe we don't yet have good ways to think about how they might impact on financial performance in the future. And so I think generally that's a big challenge, but there's a lot of work being done to try and improve our capabilities around that. But I think generally the way that we try to approach these things is really to think about materiality when we think about ESG in general, and different sectors, and particularly different parts of the world, different types of topic areas will be more or less material to a company's operations. And by focusing on those areas that are likely to be more material to financial performance, it allows you to narrow the focus a little more and focusing on getting the best data you can and making the best decision you can on the most important issues. And then there might be other issues that once we've tackled those major priorities, we can think of in a bit more detail about afterwards.
Excellent. Ruben?
On ESG within business, I think for any organization starting, I think a key place to start is maybe adaptation of like existing frameworks, and you adapt them within your business. So if you're looking at ESG and particularly the environmental bit and things to do with, say, climate related risk and disclosures, then a practical thing would be adaptation of like TCFD. Then the question becomes, how do you actually implement TCFD? Because most people know it as a framework, as a report, and they don't know how the implementation looks like. So one thing we are doing, for example, within UNEP-FI, we've been running TCFD banking pilots in different regions just to help financial institutions, and this has particularly been banks, how they can actually take TCFD and take like the 4 pillars of TCFD, and how do they actually do it for like within their risk management divisions, but also as part of their annual reporting. Because some banks do not have any experience with this, we are also running like TCFD implementation webinars. And for example, we have one coming up in a month for Middle East and Africa. So I think starting from existing frameworks is a good place to start. Then I think, as Badia said, over time, then you end up narrowing down to very specific metrics which are specific to your business, and customizing your ESG framework for your business model.
Yeah.
Bardi, I don't know if you're aware of how your information that you're providing these companies is being used in their financial reporting, not just in their understanding of their assets risks.
So yeah, again, right now, essentially we rely on the client themselves to be able to interpret our results and be able to use it for financial reporting, which we're okay with. A lot of the reporting right now, I think it's really great. Like, Rick, you mentioned you guys are providing like more quantitative stuff for reporting, which I always think is good to incorporate some of the GCMs and things like that. However, I think that I will just say one thing. I think one of the biggest problems with different institutions is that there's a disconnect between ESG teams that are placed in those companies, the board, and also individuals who are actually on the ground who have to make decisions on the operations of different assets for physical climate risk, at least. So I think some better unification on that front, such that you're not treating reporting as some separate thing. It's all the same. It's all within the same realm. is really important.
Okay, we've got time. I've been given permission from our convener for one more question that I'll throw out there. That, and I'm sorry to everyone that has asked all these questions and I haven't been able to get to them. But what's missing? What are the tools? What's out? What's not out there? What's missing in the tools that are available? Where's the opportunities to provide more value out of these tools? Over to you, Rick.
Sure. I think there's a lot of room for development, I think, around kind of TCFD and climate. But I think one key area, which I think is going to be quite transformative, I think, in the investor world, and it's something that I think Bardi is working on, and Trucost as well, is really trying to get to be able to understand what are the, in a quantitative way, what are the financial risks associated with different types of transition and physical risks associated with climate, but to do that in a way that's completely scalable. So essentially, when you have an investor that might be investing in thousands of equities all around the world, each with hundreds, thousands of assets, you can run a sufficiently kind of robust and reliable model to understand what are the financial consequences for those assets, those companies, and all the way up to the portfolio. I don't think we're quite there yet. There is definitely groups that are trying to do it, and we're working on that as well at Trucost. But I think having that will really be a huge step forward in trying to make better decisions around managing portfolios with climate risk.
Thank you, Reuben.
On my end, I wouldn't say, so I wouldn't call it what's missing. I think one risk we face, which is a big risk, is, as they call it, there's the whole thing about greenwashing and with your SDGs, rainbow washing and everything like that. I think one key risk is whether businesses are consciously adapting their business models, for mitigation of climate risk and adaptation. Because think of it this way: if all financial institutions in the world, for example, that are heavy invested in carbon, do not have very clear plans for transition, maybe in the next 5, 10, 15 or so years, and all they do is use these tools to improve their reporting. If you actually think about it, what we are doing is ending up with better reporting, but really we are not dealing with the climate change crisis, right? The issue. So I think organizations taking a very conscious effort and say, okay, this is our transition plan for the next 10 or so years. This is what our divestment plan looks like. This is what our decarbonization pathway looks like, and actually adapting business models. Otherwise, if there's the risk of going so much into tools for screening and reporting without actually adapting business models to respond to climate change. I think that's a big red flag.
Great.
Yeah, I just want to really stress the importance of transparency in the tools. I think that if there is an expectation for people to have skin in the game in this, if you want people who have skin in the game to actually make a really big decision on the basis of climate related variables, you need to provide transparency on what data is going in, how it was tested, how it was validated, what methods you used, and whether or not it was reviewed by experts in the specific specialty that you're dealing with. Anything lower than that, we cannot. I understand there's sort of an expectation. We look at big financial institutions constantly. And I don't want to be always, I'm not trying to be an apologist. I do think there is a level of neglect sometimes, but with some institutions. But in general, if the information isn't, if you're not being transparent about it and the metrics, then you should not expect people to make large decisions off of that. One thing that we do, we understand that this is a marathon. It's not a sprint. It is a sprint in that we need to reduce our emissions, no doubt. It's a sprint. We need to bring it down to zero. But in terms of actually sitting down with the client, although we're trying to be a very scalable software platform, we also understand that there is a huge learning curve for clients. We have one, for example, large asset manager. We've done weekly meetings with them for, I'd say, 3 to 6 months at this point. And we understand that, because if you're going to make a big decision, whether you're going to spend billions of dollars on a resiliency strategy, or if you're going to buy or sell an asset, that is a huge, huge risk if you're not quantifying it or communicating it properly. And that's really all I have to say about that. Yeah.
Well, powerful messages from each of you. Thank you. This has been a pleasure to watch these presentations. So first of all, I want to thank Rachel Antwi for the conference as a whole. It's been a fantastic conference, and the sessions that I've been able to watch, I've thoroughly enjoyed. Very high standards, and the high standards we saw here in this panel session today. I'd like to thank our three panelists, Rig, Ruben and Bardia, for giving us such a fantastic overview of the tools available. And as I said, your questions will be passed on to the panelists, and hopefully we'll be able to get that information back to you on the questions that you ask. And thank you all for joining us, and thank you for the panelists and Rachel.
Thank you. Thanks, everyone.